Hi, I'm Brooke Thackeray. Thank you very much for joining me today. Today we're going to take a look at what to expect in the upcoming week. And there's a little bit of a concern going on right now in the news that's coming out in the marketplace and how investors are reacting to it. We're going to get into that a little bit later on. And we're also going to talk about the industrial sector and what might be developing as it starts its seasonal period shortly as well. Before we do that, though, I'd like to take a look at what happened in the stock market last week, and also too as well the sectors of the stock market and where we stand today. If we take a look at the S&P 500 here, you can see here that the S&P 500 was a little bit down last week, nothing really significant. Still well above its 50-day moving average. My concern is really if it breaks below this October high, which was the middle of the double bottom breakout that took place in November, and also would be below the September high. I think that's when investors would really shift their perspective overall from a technical level on the S&P 500. We're not there. Overall, the S&P 500 right now stands in pretty good stead on a technical standpoint. If we take a look at what happened last week, we did see some up and down days at the beginning of the week. Then we saw this down a day on Thursday. Then we saw this down day on Friday as well. Now, so what took place towards the end of the week? Well, Joe Biden announced his spending plan for when he comes into office of $1.9 trillion. Now, we used to talk billions, but now we talk trillions. This was actually higher than expected. So it's a little bit of buy the rumor and sell the news, because investors were actually looking at the stock market, pushing the stock market higher based upon higher growth, fiscal spending, which would provide some short-term economic relief into the economy and also push the markets higher typically. But what we saw last week was a response where investors basically sold off based upon the overall plan, even though it was higher than expected. Now, I know some people looked at it and said, well, you know what, there's a little bit of concern, it's going to take longer to implement, and there are some concerns with it. But we did see overall good news, and what would typically be considered good news to drive the market higher, and the market did move higher. So when the market comes up with good news and investors react negatively to it, that's a little bit of a concern. We're going to talk a little bit more about that later on. If we take a look at where the S&P 500 is last week, we saw a loss of almost 1.5%. The NASDAQ was just a little bit more than that. Emerging markets has been stronger, although it was negative last week, stronger than the S&P 500 once again, as investors have been concentrating on the emerging markets. That's partly to do with expectations of the U.S. dollar heading lower because of greater government deficits, and a lower U.S. dollar tends to help emerging markets perform better. If we take a look here at the Russell 2000, once again, strong week after another strong week the week before. So we saw two back-to-back weeks of strong performance, and that's partly being the result of investors expecting the fiscal stimulus to actually help the small cap sector as well. If we take a look at the TSX Composite, down less than 1%, which is significantly better than the S&P 500. And one of the reasons was the energy sector. Now, here's the sectors in the U.S. This is the energy sector in the U.S. was up 3%, over 3%, and Canada performed well at the same time. Also, to the utility sector last week and the real estate sector were both positive. Overall, interest rates did pull back a little bit last week, which helped to support these sectors. Now, interestingly, the technology sector was actually performed worse than the S&P 500. Usually when you see an erosion on the interest rates, you actually see the technology sector perform quite well, but that's not what we saw last week. And we did see the communication services actually perform very poorly last week based upon a lot of political stuff that was happening as far as that goes, which I don't want to get into, of course. And I also want to take a look at another sector of the market, and that's the gold sector. If we take a look at the gold sector here, you can see here that I just wanted to point out a couple things that took place last week. Now, we saw this top in August here, and then we saw this pull back, and then the gold sector started to rally at the beginning of December once again. Now, on a seasonal period, the gold sector tends to perform well, starting usually late December, but it started a little bit earlier, and sometimes that does happen, of course. But started a little bit earlier, and then we've seen some weekdays happening here. I'm going to zoom in a little bit here. You can see this big down day. That was the Friday not last week, but the week before, and this is Friday last week. Now, this graph here represents the yield on the U.S. 10-year Treasury note, and you can see here that we had rising rates taking place, which drove the gold price down, which would be a typical response. Now, on Friday, gold price went headed lower despite the interest rates moving lower. So what we might be seeing here is gold finishing up its seasonal period a little bit earlier. It started early, and maybe it's going to finish up its seasonal period a little bit earlier. So what's going to be interesting is if we do see gold continue to underperform, if interest rates move lower, that could indicate some further weakness ahead for the overall sector as well. If we take a look at the interest rates here, we can see here that this is the 10-year interest rate, a little closer as far as that goes. We've seen this really strong rally that's taken place, did become oversold, both on a RSI basis and a full stochastic oscillator basis. And recently we've seen just this downtick for interest rates. It's going to be interesting to see what takes place for interest rates coming up shortly, and how that affects the overall market. I also want to take a look at the Canadian dollar versus the US dollar. Now, there's a couple big driving forces for the Canadian dollar on a relative value basis compared to the US dollar. One of them is the price of oil. Canada is still somewhat of a petro currency. And the other one is the spread differential between the 2-year bond rates between Canada and the US also has an impact. Now, of course, there are other factors as well, but these tend to be two of the bigger factors. And you can see here overall that, as the price of oil went down, you saw the Canadian dollar head lower as well. And we've seen the bottom for the Canadian dollar relative to the US dollar, 69 cents. And here we are in 2021, we touched on 79 cents. That's a huge rally overall. And that's partly being explained by the performance of by oil moving higher. There is something that you do need to be a little bit concerned with as far as that goes, and I am going to get into the energy sector a little bit more coming up in a video at some point in the next few weeks, because the energy sector does start its seasonal period late in February. There can be an opportunity to enter earlier if we do see some volatility. January tends to be a little bit of a volatile month for the energy sector. We haven't seen that yet really, but it can happen. But I'm going to get into that a little bit in another presentation. But on a technical basis, look at this. We've seen the Canadian dollar move higher. And at the same time, on an RSI basis, it's been moving lower, and full stochastic oscillator been moving lower as well. So this is a divergence. It doesn't say anything at this point because it can continue to go on. But very often it does indicate that there's going to be a trend shift taking place, and you would expect that we'd actually see this, the Canadian dollar actually weaken at this point. Now, the reason I bring all this up, and if you take a look at the US dollar worldwide, it's being grossly oversold, huge short positions against US dollar. A lot of that's being based upon more money printing affecting the US dollar, and also as well, fiscal spending with huge deficits. And so we've seen this huge pushing of the US dollar lower relative to other currencies. Now, other governments are also printing, spending a lot of money, or the central banks are also printing as well, but we've seen this really concentrated effort as far as the US goes. Just recently, we started to see a little bit of improvement in the US dollar relative to world currencies. Now, relative to the Canadian dollar, the US dollar actually tends to perform well from early January until mid-March. Now, it's a shorter time period, and it tends not to be a really strong period for the US dollar, but it is something to watch, particularly if we start to see the energy prices roll over and go lower at this point. We could see a little bit of further weakness. So I just wanted to point that out. Watch out what's taking place overall in the energy sector particularly, and how that could affect the Canadian dollar relative to the US dollar. I want to bring in S&P 500 earnings expectations as well. And this is from Refinitiv here. Excellent. They put out some excellent work on detailed earnings reports, what's expected overall in an aggregate for the S&P 500. If we take a look at 2021 Q1 right here, and then also to Q4 for earnings expectations, we can see this ramping up that's taking place. And really this is, if we take a look here at what's taking place, we saw this down, and then we're seeing this up here. And if we take a look back at 2019, we really didn't see this very strong earnings overall for the S&P 500 in the marketplace. And this is partly because there's the expectation that the pandemic is going to end and the economy is going to roll out and pent-up demand and all that looks a little bit strong for me overall, but it is something that is expected now. Something to track overall as far as this goes. Now, we want to watch what's going to take place as far as the expectations go coming up. Because if we take a look at bad news versus good news, and I want to talk a little bit about that before I talk about the earnings coming up as well. Now, when you have bad news, you typically get a negative response in the market. And that's very natural. So bad economic news translates into negative response in the markets. And that's not a big, huge concern. It's when you get a whole bunch of bad news strung together, then that typically says, hey, there's a trend going on, the market responds negatively to it. On the flip side, good news often produces a positive response, which is natural, of course. Now, where it gets a little bit tricky is when you have bad news happening, taking place, and there's a positive response in the market. Now, this could be because the Federal Reserve is coming in, the bad news economically comes out, expect growth is weaker or whatever it is, and we saw the non-farm payroll number at the beginning of the month be weaker and the market respond positively a little bit. And that's because they're expecting the Federal Reserve or the governments to come in and provide some stimulus to the overall market. And that typically says the market is, investors really want to push the market higher and look for a more sustained rally. So when bad news produces a good response, that's a good thing. It means typically there's a little bit of strength that has some legs to it. If we take a look at when there's good news that comes out and there's a negative response, that's where we have to be a little bit concerned here overall. And that's a concern right now. And if we take a look at when this happens, it typically means that there's an inflection point on investor behavior. That when good news is coming out, they're going, hey, you know what? We're concerned. It doesn't matter at this point. Good news is coming out. We're just concerned. We're overall with valuations or whatever it is, and the market tends to actually have a little bit of a softening. And we could be at that right now, actually. What we saw last week on Friday, we saw the U.S. banks start to kick off unofficially the earnings season, and they came up with some decent results, and yet they underperformed the market as a group as well. So this could be buy the rumor, sell the news once again. And for the financials, this could be an indication that investors are going through this process where as the news comes out, they're reacting negatively to it. So the big concern is we do have Monday off, a holiday in the U.S., of course, Martin Luther King Day. And then we have some earnings coming out. We do see a continuation taking place with some of the financial companies as well. And then we see J.B. Hunt Transport coming out, give an indication as far as the overall trucking in the States go. Netflix, obviously, is going to be important. Then we saw healthcare. We'll see healthcare. We'll see consumer staples, Morgan Stanley Airlines, Kinder Morgan, U.S. Bank Corp., Travelers, Baker Hughes, IBM, Intel. That's going to be an interesting one. And the reason why it's interesting is Intel's been so badly managed over the last number of years, and they really lost a lot of ground. And last week, just before that, they announced that the CEO was leaving. And despite technology going down on the day, Intel was up substantially. Investors really looked at it as positive because it really has been a poorly managed company overall. And so it'll be interesting to see how investors react to the Intel earnings coming up and the announcements made on that day. So for earnings coming out this week, it's important to take a look and see how investors react to them. Not so much whether the earnings beat expectations or not. If they beat expectations and investors sell those companies off, that will be what we saw last Friday, and we've seen a little bit of action as far as the Biden stimulus plan. If we see more of this, it could be the market's in for a softening period. Now, it doesn't mean the market's topping out at all, or the market's falling to pieces. It just means we might be entering into a softer phase right now and see a little bit of a pullback potentially. If we take a look at from an economic front, we can see here housing starts on Thursday. Building permits, existing home sales on Friday. So we get an indication for the home building sector. Now, the home building sector seasonally finishes the seasonal period at the beginning of February, early February. So it'll be interesting to see how investors respond to this, because home sales have actually been strong. Prices have been going up. And once again, if we start to see a little bit of a sell-off taking place here, it could be investors once again are actually looking at, maybe things are changing. This could be the inflection point on their expectations. We also see market, composite, manufacturing, services as well on Friday. Give us a little bit of an indication overall on economic expectations. I want to talk a little bit about the industrial sector. And if we take a look at the industrial sector, I want to start by taking a look at my book here. This is my Thackeray's 2021 Investor's Guide. I know I've mentioned this before. It's out in the stores. I'm going to flip over to the industrial sector, and I have mentioned this before in a previous video. It does have some strength here on January 23rd until May 5th. And if we take a look here at this time period here from 1989, 1990, we can see here it tends to be strong. Average from January 23rd until May 5th, 4.6% and positive 77% of the time. I mean, nothing in the industrial sector really doesn't produce, even in a strong seasonal period, doesn't produce a huge gain relative to the S&P 500 on average over the long term. It's really the frequency, and it's really trying to get on the key seasonal sweet spot for when it does happen. And the industrial sector tends to move in spurts sometimes relative to the S&P 500. If we take a look at February for the industrial sector, this cross represents the median for the industrial sector. Relative, if we take, the relative to the S&P 500 is this diamond. So we tend to see stronger performance. And we do see this uptick in February relative to the S&P 500. It tends to be outperform at 50% of the time, which is much better than in January, which is 33% of the time. So we tend to see that pullback that takes place relative to the S&P 500 in the industrial sector. And if we take a look at the performance from 2015 to 2019, the 5 years, you can see once again that February tends to be strong. The median is the square here, which tends to be above the average for the S&P 500 in this period. So one of the sectors to watch out for sure. And if we take a look at where we stand right now, we can see here that the industrial sector did underperform substantially. So this is relative. I'm using the ETF in the States, XLI. So this is relative to the S&P 500. We did see that correct, and we have seen this uptick here that's taken place since March, or I should say May, and we did see that breakout that's taken place. Now, we have seen this pullback that took place in November heading into the end of the year, and if we take a look here, we're starting to see a little bit of a consolidation here, and we might be breaking this relative downtrend line taking place here. So here we are starting the seasonal period coming up shortly on January 23rd, and so it's going to be interesting to see how the industrial sector actually starts to perform as we enter into a seasonal period. Right now, we want to break above this downtrend line that was broken before. We're starting to see as I mentioned, this little bit of a consolidation. If it breaks above this line, it could be positive. If we start to see further weakness in the industrial sector coming up, despite all the stimulus plans and everything else, that could be an indication the market could be a little bit softer. But typically, on average, the industrial sector tends to perform better or have a strong seasonal period starting January 23rd, on average, of course, until May. So something to watch out for. Watch out for the relative performance of the industrial sector over the next few weeks as we tend to start its seasonal period. If we see continued underperformance, despite announcements as far as more fiscal spending and everything else, that could be an indication that we could see softness not only in the sector but overall in the market. Now, we are in the strong seasonal period, 6-month seasonal period for the stock market. So we can see some volatility, and on average, from the end of October to the beginning of May, early May, tends to be quite strong. So we would expect this industrial sector to actually continue to perform well here, but if it doesn't, it could be a little bit of a concern. Thank you very much for joining me today.